Hi. I just returned from Omaha, having attended the Berkshire Annual Meeting, which is always just a fabulous event. It's great fun. I got to see some old friends, make some new friends, bump into a bunch of people. It's really a terrific time away and reconnecting. I loved it. On Friday, before the event, I had the opportunity to speak at an event called VALUExBRK. It's the second year the event has happened. It's sponsored by Guy Spear. Guy Spear is the money manager and founder of a firm called Aquamarine. He also is the author of a book called Education of a Value Investor, which is a terrific book. But more importantly, Guy is a wonderful human being. Generous, thoughtful, engaged. I just really had a great time spending time with him. The event featured 12 speakers, which was pretty amazing. Very honored to be among that select group. I was among some amazing speakers, and when they get to you, you always wonder, wait, why am I here? All right, so at that event, I presented some work I call The Value of Growth, and I want to share that with you. All right, so if Buffett will tell you that investing is fairly straightforward, maybe even simple. It's certainly not easy, but it is simple. And according to Warren, the key to investing is you want to estimate the intrinsic value of a company and then compare that estimate of intrinsic value with the price you have to pay, market price. And if there's enough of a gap, margin of safety, that investment should be very compelling. If you push further and ask Warren kind of what are the key drivers of intrinsic value, he will tell you that there are two primary. He'll call it a moat. It is the durability, duration of cash flows, how secure they are, something I would call a sustainable competitive advantage. That's part one. And we know a fair amount about competitive advantage over the years. A lot of very bright people have contributed to our study of that. And in fact, I'll do another video on that later this week. The second piece he would then say is estimate growth, and really the value of growth. Now, the problem, of course, is valuing growth is tricky. In fact, there are no real accepted tools that help us with valuing growth. Using a reverse DCF or other kind of metrics can work, but they have some serious limitations. So what I presented at ValueX was some tools I've developed over the last couple of years that I call, wait for it, the value of growth. And I want to walk you through those slides. It's a fairly short presentation. Each of the speakers at ValueX had about 10 minutes, and I think I made it under the limit. So let me walk you through my thoughts on how to value growth. All right, so here's the valuation challenge. I've done a 10-year explicit forecast. I'm assuming away the terminal value for a moment, but I just have cash flows that are growing every year. And this is the challenge, what I call the valuation challenge, is how do you value this stream of cash flows? The primary tool we have is a DCF. It's got some limitations. For the people that are more technically oriented, the problem with a DCF is you have three unknowns, the magnitude, duration, and growth of the cash flows, but a single equation. So you can't really solve for it, which is sort of the challenge. So rather than attack the problem the way it's presented in this chart, I've decided that what if we changed the problem and we transformed it into a different problem? And now we have two cash flow streams, one blue, which is essentially a steady state series of cash flows, which interestingly, if you assume those cash flows will last forever, is fairly trivial to value. We can use a perpetuity formula, which is straightforward and is used in lots of different areas. The green is obviously the challenging part. That's the growth part. But I like this split because we can value blue, and now all we have to do is focus on green. All right, so now here is the S&P 500, where you have green is your market implied value of growth, and earnings, the blue part is your earnings power value. And this is the market implied value of growth, green, and earnings power value for the S&P 500 going back to March of 2010. I don't go further than that back because you have the financial crisis. and the numbers go very wonky for 2 years. Now, I'd like to have a longer series. That'd be pretty cool, and we're working on some stuff to do it, but we still have to kind of eliminate those years because the data is so much different because of the crisis. So here's the market implied value growth for the S&P versus earnings power value, and you can see that you've seen a huge expansion in the value of growth over the years. Now, what's important to keep in mind is that blue is determined by the company's financial performance, and green is investor expectations. Green is what you're paying for growth, what other investors believe will be the company, or in this case, the index, the companies behind the index, will deliver in terms of that growth performance. So green is a set of expectations. Blue is based on actual performance. What you see very clearly in this chart is the market implied value of growth, when investors are willing to pay for growth, has expanded significantly from 2011 until today. I'll show you some more charts. In fact, it's as high as it's been in this time series. All right, so we can now take a look at earnings power value as a percentage of enterprise value. That's what this is. It's this same chart from before, but now I've just taken the earnings power value as a percent of the S&P 500. The red line is your 10-year average. The green, orange line is your 5-year average. What's interesting is how close those are, even though you've had a lot of variability over the years. And what you see is the earnings power value as of the end of the year. This is through March, is 42.5%. I think this chart is more interesting. This is your market implied value of growth as a percent of the S&P 500. And again, I have like gray is your 10-year average and black is your 5-year average. And they're just as close. They're just the inversion of the ratios before. This is more interesting because it shows you that the market implied value of growth peaked in the fall of 2020. We all sort of know that now with hindsight, although I did run these charts at the time, and it was fairly obvious that investor expectations for growth was significantly higher than we'd seen any time in the last 10 years. And we're almost back there. We're climbing back there. So the market implied value growth for the S&P 500 is very high at the moment. Not saying the market's overvalued. All I'm saying is investors are willing to pay more for growth than they have for most of the last 12 or 13 years. All right, so here's the S&P 500 in the same exact data as this one, but I just done it on an annual basis, just so you can see. Same exact trend. This is more helpful when you look at an index, but I'm going to take a look at Buffett's favorite stock in a minute, Apple, using these tools. So I wanted to convert the S&P 500 market implied value growth and earnings power value to a slightly different chart. All right, there's Apple's enterprise value. This is the largest single holding at Berkshire Hathaway. They made a lot of money, as they've talked about. They trimmed the position a bit in the first quarter. We found that out on Saturday morning, but they still own a lot of it. You can see that the enterprise values increased dramatically over the last 8 years, and Buffett's obviously benefited from that. If we take Apple and we split it into two components, the market implied value of growth versus earnings power value, you can see that they've benefited significantly from an expansion in what the market will pay for future growth. Remember, green is investor expectations, blue is actual performance. So if they continue to perform in line with recent financial results, the blue will stay steady. Green and shifts in green will determine stock performance. This chart's probably even more interesting. This is comparing the two, market implied value growth as a percentage of the enterprise value. And you see is that right now that this is the highest, the greatest as a percentage of enterprise value that investors are willing to pay for Apple's growth. So you're paying, remember, you're paying for green. So Apple has not had impressive results, certainly on the product side. Services are doing well, but on the product side, they continue to struggle to deliver growth. Yet, investors are paying the highest percentage, pretty close to the highest percentage of enterprise value for growth that we've seen in a long time. So this is what I presented. I'll have some more videos like this over the next couple of weeks. I start to roll out some of the new tools we've developed. Obviously, I appreciate any feedback, questions, or comments. Thank you.